On today's show, we're going to talk all about Roth IRAs, what they are, how they work, and why they may be one of the most powerful tools for your retirement planning. Welcome to another episode of the Simply Retirement Podcast, where we want to empower and educate women to live your retirement on your terms. I'm your host, Eric Blake, practicing retirement planner with over 25 years of experience, founder of Blake Wealth Management, and I would not be the man I am today without the women in my life. Roth IRAs are a tremendously valuable tool, especially if you're now filing single or you might be at some point in the future, which statistically often turns out to be women. Knowing exactly what a Roth is, how to use it effectively, can potentially help you keep more of your money and reduce tax surprises. Joining me once again is Wendy McConnell. Wendy, how are you?
I'm good. How are you?
Perfect. I started to make this show, the title of this show, Everything Wendy Wants to Know About Roth IRAs. How's that?
I love the idea of Roth IRAs, and I've been wanting to transfer some of my holdings into a Roth, but then it's like, okay, well, then you have to pay the taxes and you have to do this. So this is great. I'm very much looking forward to
You just like tax free. That's what it is. I know you. Tax free is good. Tax free is good.
it.
Well, so basically, here's what we want to do. So by the time we get through this episode, what I want to make sure is that we've identified, again, what a Roth is, the basics of Roth taxation. I think that's important. We're also going to talk a little bit about why Congress emphasizes Roth IRAs and how that actually helps us. We're going to talk about why tax diversification matters, as well as how Roth IRAs can help you avoid some of the hidden tax traps, higher tax brackets, higher Medicare premiums, even some of these surprises that we don't really think about in advance of your retirement years. We're also going to talk about the 4 ways of how to fund a Roth account. And finally, we're going to talk about be sure you understand how to take money out. What are the basics of taking money out of your Roth to make sure that it is actually tax-free? So we're going to cover all that. How's that sound?
Sounds good. Let's get started.
Now, one of the things before you just stick around and make sure everybody sticks around until the end, I've actually put together a free Roth IRA toolkit that makes everything we're going to cover today just a little bit easier to apply to your own plan. And as always, for all the links and resources shared in this episode, you can visit the simplyretirementpodcast.com. And always, again, just want to make sure you don't forget, if you have a question, a topic idea, any specific retirement challenges you'd like to hear covered on an upcoming episode, you can visit the simplyretirementpodcast.com/Ask Eric. All right, so let's get into the basics here. So first thing is, so many people don't actually realize that Roth IRAs were first established in 1997 by a senator named William Roth. Actually, that's where the name comes from.
Okay.
Now, I'm going to start with one of the frequent questions I get. One of the things people think about is Roth, a Roth IRA. Well, how much can I earn? How much interest can I earn on a Roth account? And I think it's obviously important to understand that a Roth IRA is not an investment. A Roth IRA is a tax-advantaged account type.
Okay.
So the Roth IRA itself doesn't earn anything. So here's the way I always describe it. And hopefully this is going to create a visual that makes sense. So the way I talk about Roth IRAs is you want to think it like an umbrella. And the whole purpose of our umbrella is to protect our money from Uncle Sam, right? Just like the umbrella is supposed to protect you from the rain, the umbrella itself, that's the Roth IRA. That's what protects your taxes, and hopefully keeps Uncle Sam away from your taxes, right? But underneath that umbrella, you choose how you want to invest that money. So the Roth IRA, you invest in stocks, bonds, mutual funds, exchange traded funds, CDs, even savings accounts. That's what determines the actual rate of return of your Roth account. It's not the Roth itself. The Roth is not an investment vehicle. It's an investment type or an account type.
So is it like the 401k, but just with after-tax money? So it's kind of the same thing.
401k is an account type. Roth is an account type.
Gotcha.
It's what you invest in that determines what your rate of return is. And I think this is one of the interesting things. Again, just thinking how I describe these and how I talk about them. You could invest in the exact same thing in your 401k, in your pre-tax bucket, in a taxable account, just a brokerage account, and your Roth IRA. You could buy the same stock. Let's say you buy Apple stock in all 3 of those. The only difference is how the money gets in there, and maybe more importantly, what are the tax consequences when the money comes out?
Okay.
So you think about those three key buckets. 401k, you put it in as pre-tax, but it comes out taxable. Brokerage account, it's after tax, but you pay tax on your earnings, your dividends, your capital gains, all that good
But
stuff.
just on the earnings.
Roth IRAs are after tax, and I'll describe just a kind of a scenario to make that hopefully seem a little more realistic. but it comes out tax-free as long as you meet all the rules, guidelines that come along with that. And we'll talk about those here in a little bit as well.
Okay, so I have a quick question.
Sure.
What is the difference then between a Roth and an individual account? Like, why would one use one over the other?
So that's really where, from a planning perspective, that's where you decide which of those is going to be more optimal for my situation. So you think about it, like when you talk about an individual, we're going to assume you're talking brokerage account, right?
That's what I meant.
So think about the age restrictions on some of the different accounts that we have access to. So just a brokerage account, individual account, there is no age limit. There's no 59 and a half. There's no required just 73 or 75 for required distributions. There's none of that. So you can get to the money anytime. So if I'm 25 years old and I'm putting money into my brokerage account and I need the money to buy a house 10 years from now, and I'm 35, not a problem at
You
all.
can take that money.
Exactly. Roth accounts, you've got the age 59 and a half. And again, we're going to go through all the distribution rules here in a bit, but in general, over age 59 and a half, it's tax-free. There's some other rules we have to be aware of as well, but in general, that's the concept, is it is 59 and a half for the full account value to be withdrawn tax-free
Okay.
for a Roth account.
Okay. So after you're 59 and a half, can you continue putting money into a Roth?
As long as you have earned income, you're just got to jump all the way. We're just going to get all about Wendy. You're good. You're good. Now, I appreciate it because, again, it just helps me make sure I clarify all the different pieces, because this is important. Roth IRAs are tremendous vehicles, but it is important to understand how they work. So here's how most people contribute. Let's kind of walk through step by step how most people contribute to a Roth, because, again, a lot of people have these same questions. So when you're talking about after tax, sometimes even that is confusing. What do you mean by after you put money in a Roth after tax? So let's talk about what that means. So the first thing is you think about just the normal W-2 worker employee. You receive your income through a paycheck, right? You have taxes paid on that income. And then whatever's left over goes into your checking account or your savings account or wherever you have it going in, your direct deposit. In most cases, then you're making your Roth contribution from your checking account, from your savings account on money, again, that has already been taxed. And we talk about Roth accounts being contributed to on an after-tax basis. That's what we're talking about. This is money that's come out of your paycheck, gone into your bank account, and now what am I doing with that? One option you have is to contribute to a Roth IRA.
Okay.
That makes sense?
Yes.
And again, so then all the dollars that you're putting in have already been taxed. Now, the big key is now they will grow tax-free. And assuming you meet certain criteria, we're going to cover in just a little bit, eligible withdrawals down the road can also be tax-free. And that's really where the big advantage of Roth accounts can come in.
So this is as opposed to the 401k, where the money comes out of your paycheck before it is taxed.
Right.
And it goes into that account. So that money has never been taxed. So this
Exactly. So that's why you have required distribution. So that's when you say, okay, Uncle Sam's not going to let you defer taxes forever. At some point, you're going to have to take some of it out, right? You don't necessarily have to spend it, but you got to get it out of the IRA, pay Uncle Sam, and then you can do whatever you want. And that's what we're going to talk about, some of the advantages that Roth accounts have over those other vehicles. And so here's also one of the questions that I get a lot as well. And it's kind of the way I put this episode together is just the frequent questions that I hear. One of the questions I get is, well, these things are it's almost like a too good to be true story, right? How can this be real? How can I get tax-free money building up? Won't Congress eventually take that away from me? And as I've talked about on other previous episodes, and this is what I tell our clients all the time, the advantage we have over Uncle Sam or Congress in this case is that they tend to focus on this year or the short term, where we can look at many years in advance and we can choose actions to help us reduce our taxes in the future and to reduce our lifetime tax liability. So Congress is actually, with some of the recent legislation, Secure Act 2.0 to be specific, they're actually encouraging more Roth contributions. They're giving you more ability to put money into Roth accounts. So for example, now they've actually had Roth 401ks for a while. But with Secure Act 2.0, Roth 401ks also don't have required distribution. So Roth IRAs, and we'll get this in a little bit, Roth IRAs don't have required distributions like a traditional IRA might. That's now the same thing.
Tax already been paid.
Right. The Roth 401k, that was a little bit tricky. So actually, up until Secure Act 2.0, you actually had required distributions for Roth 401k accounts. It was still tax-free, but there was an age where they said you have to start taking money out whether you want to or not. And so that was an encouragement to roll the money to an IRA, which is one of the options we also talk about a little bit on funding a Roth account. But now Roth 401ks and Roth IRAs, no required distributions. But what they have also updated recently with Secure Act 2.0 is now you can actually choose to have your employer match go to the Roth side of your 401k. You used to not be able to do that. I could contribute to the Roth 401k, but any matching would still go to the pre-tax or the traditional side.
Okay.
Now I can have that money go to the Roth side. I can have my matching contribution go to the Roth side. Now, what's important to know is if you choose to do that, again, it's after tax. So you have those matching contributions. You're going to pay tax on it, but then it's going to grow tax-free from that point forward. But it is an option. So depending on your financial circumstances, your tax bracket, all those things we encourage you to look at, you could say, yes, it would make more sense to get my matching contribution put into my Roth account, my Roth 401k account. Now, for business owners, there's also now Roth Simple IRAs and Roth SEP IRAs. And we're not going to go into the specifics of those here. But again, just the point being, Congress is now encouraging more Roth contributions. And here's the bottom line is because it's all taxable this year. It's tax revenue. That's what they're looking at.
They want to get money.
The more money you're putting into your Roth accounts, regardless of what type of Roth 401k, Roth SEP IRA, Roth IRA, whatever it is, more tax revenue this year.
Okay.
Not thinking about, okay, if we're all able to put all this money into the Roth accounts and now it's growing tax-free for the rest of our life, that's a pretty good thing. So that's why I say the advantage we have over Uncle Sam is they're only looking at, yes, this year and now. We can look the next 5 years, 10 years, 20 years to see what that impact's going to be and how much more flexibility we have from a tax standpoint by utilizing these vehicles.
And let's just say 5 years from now, Congress does say, you know what, we are going to tax that money coming out. We can plan ahead to make sure that the direct impact of that is as little as possible.
Potentially, yeah. But again, the reason that I don't have any feeling that would ever happen is, again, you're losing from, again, this is it takes an act of Congress, right? So you've got to say, what are they giving up in order to do this? So when you're talking about money, even for example, the money you're putting into it, that's no longer taxable.
Right.
The earnings are tax-free. So could they at some point change their mind and say, okay, yeah, we're going to start taxing the growth of Roth accounts? It's possible, but I think it's still unlikely in terms of just, again, where things are at right now.
Okay.
So here's the other thing. Here's one other thing important for our listeners that maybe actually still be working, more higher earners. This is something that's going to happen actually next year, 2026. If you make more than $145,000 a year and you're over 50, you have the ability to make catch-up contributions into your 401k account. Well, starting next year in 2026, if you're above that $145,000 income limit, you're actually going to be required to put money into the Roth side. Those catch-up contributions are going to have to go into the Roth side of your 401k account. Again, they're going to force you to pay taxes.
They're not forcing you to catch up, but if you are catching up, then they're going to, I got you.
It's going to have to begin more tax revenue. So again, back to the point we were just talking about, the likelihood of them changing all this stuff down the road, pretty unlikely because of all the implications there would be in order to make those changes.
Well, I'm glad to hear that, Eric.
But again, ultimately, the more the Roth pathways we have, more ways we can get money into Roth accounts. Ultimately, again, it's building tax-free income, and we're controlling our tax situation in retirement. So that's why, again, kind of the answer to the question about, well, could they take Roth away or could they change things? You can never say never. Nothing's ever permanent. Just like they changed the tax laws. Now the new tax rates are quote unquote permanent. They're permanent until the next administration or until whenever, right? So anything is possible. So we never say never, but from the standpoint of, hey, we just take advantage. We just do what we can based on the knowledge that we have and go from there.
All right.
Now, one of the things, and we've kind of touched around this already, but in terms of just the importance of tax diversification being just as important, in my opinion, as portfolio diversification. So you think about, we talked about, you can buy the same stock in all these different buckets. When you think about that, again, tax diversification, you talk about diversification, most people think about, well, how much do I have in stocks? How much do I have in bonds? How much do I have in cash? And that's the diversification conversation. And doesn't mean that's not important, but ultimately it's how that money gets taxed when it comes out that I think is more important. And what's caught people off guard in the last, especially as 401ks have become so popular, like the retirement vehicle is a 401k now versus like a pension. Well, most people accumulate most of their retirement nest egg in a traditional 401k, which again means when it comes out, it's fully taxable. So every dollar you have is in that 401k, you have no tax control.
Right.
Because if they do change rate, if they increase tax rates, so again, which is more likely? They're going to change their mind on Roth IRAs, or they're going to raise tax rates on just ordinary income in the future. My bet would be on they raise ordinary income tax rates at some point in the future, which means as you're taking money out of those 401k accounts, you're paying a higher tax rate.
Okay.
And we've got required distributions on those accounts. So does that end, because everything you have is coming out of there, maybe you end up being a higher tax rate in retirement. You end up with higher Medicare premiums because your taxable income goes up. So you think about all these different things that can happen if you don't have tax diversification. So to me, that's why I talk much more about tax diversification versus asset allocation and how much you have in stocks, bonds, and cash. All that is important, but we really want to think about the tax implications of how our money is invested to give us control over which buckets can we take money out. If you don't have options, you only got one option, you're pretty much stuck. If you've got three options, maybe do have some pre-tax, you're going to have some pre-tax money most likely. But if I have some Roth accounts, I have some after-tax account, brokerage account, it's just options. It's flexibility in order to draw from whichever account makes the most sense at the time.
Okay.
All right, which also, again, that all ties to our episode 65 we did on the widow's penalty as well, and thinking about if again, it's kind of the same concept of all your money is in pre-tax accounts and you're married and one spouse passes away. Now we're running into issues where, again, the same pre-tax balance is now only coming to a single individual. Now, again, we may be looking at some of those tougher challenges, the higher tax rates, the higher Medicare premiums, the higher taxation on Social Security, all these different things. So that's why tax planning becomes so valuable.
All right.
And same thing, I want to go through some of these hidden tax traps. Again, I've already touched on a few of them as we've had this conversation, but again, where Roth IRAs become so valuable is, again, required distributions, RMDs, where, again, Roth accounts, whether it's a Roth 401k, Roth IRA, do not have required distributions. So that's where, if, again, all of your money is in a pre-tax account and you eventually have to start taking that money out, you have no tax control. So utilizing Roth accounts can help you minimize or potentially reduce the impact of required distributions.
Yeah, so ideally you could take a little out of the pre-tax and a little out of the post-tax and kind of even it out.
So what I talk about is what we call filling the brackets. So you think about, okay, maybe, most people are somewhere maybe the 12% of the 22% tax bracket. So if I said, hey, I want to take out just enough from my pre-tax accounts to get me to the top of the 12% tax bracket, but not any higher. I don't want to go up to be pushed in that extra 10%, that next tax
Right.
bracket. Well, so I take enough out of my pre-tax accounts to get me to the top of the 12, and then I take everything else from the Roth account, which prevents me or hopefully reduces the chances of getting pushed into a higher tax bracket. So that's where we talk about filling the buckets or filling the brackets to see, okay, how can I utilize those tax brackets to my advantage?
Got it.
Again, we also have what are called IRMA surcharges. And IRMA, that's basically the IRMA stands for income related monthly adjustment amount. And that's basically extra Medicare premiums. So if your income gets too high, it can actually trigger higher Medicare premiums as well. So again, back to that point of saying, well, if I have no tax control over my money, there's nothing I can do about it. And that's the difference with the tax brackets versus the IRMA surcharge. With tax brackets, it's only that last dollar. So if you push a little bit of money into the 22% tax bracket, it's only that you may be $100. If you go $100 over, it's only the $100 that gets taxed at 22%, not the entire thing. With Medicare premiums, if you just go over that, what we call the IRMA cliff, if you go $1 above whatever that threshold is, you're paying higher Medicare premiums regardless.
Okay.
So that's, again, something to be aware of. And this is the other thing, just flexibility. So I talk to our clients a lot about, that at some point when you're retired, at some point, you're going to call me and you're going to say, I need $25,000. I need some large amount. I need $25,000. I need $50,000. I need $100,000. Large is always relative, right?
Right.
But it's going to happen.
Right.
At some point, something's going to happen. And I always say, I hope it's for something fun. I hope you're buying an RV, or I hope you're taking a trip around the world, but it could also be a medical expense.
Right.
And so that's where the advantage of Roth IRAs, again, becomes so valuable. When that day comes, whenever it is, and you're calling me for this big amount, the difference between having to take it from a pre-tax bucket versus your tax-free bucket is huge, or can be huge.
Yeah.
It's a difference in saying, okay, if I need $50,000 and I have to take $65, $70, $75,000 out, depending on the circumstances, to get my 50 to spend, that's a whole lot different than saying, okay, just send me a check for $50,000 because it's all
Right.
tax-free. So it will happen. And I tell you, it's just that pre-planning, setting the mindset. At some point, you're going to call me for some big amount. I don't know what the amount's going to be, and I don't know what it's for, but I want us to have the most tax flexibility possible when that time comes.
Got it.
And we spent a lot of time talking about this on other episodes. I won't spend a whole lot of time, but again, this is the impact on Social Security. The higher your provisional income, which includes IRA distributions, the higher your taxation is going to be on your Social Security. And so again, that's where Roth accounts can be hugely valuable, because Roth being tax-free does not count towards provisional income. One of the episodes we've done before, episode 54 on how Social Security gets taxed, we talked about that municipal bonds are quote unquote federally tax-free, but they actually do count towards provisional income, which means more of your Social Security can get taxed. Not the case with Roth IRAs. So you take the distribution from your Roth account, it does not get included in provisional income, so it does not change your taxation on Social Security.
I can't imagine why I get confused with this stuff at all.
Sounds fine, right?
Yeah, I'm glad that there's somebody like you to do it.
Okay, so now this is a really good one. I like this one as well. So how do we fund your Roth accounts?
Okay.
So most people just think about only one or two, and then there's two primary, but we're going to talk about all the ways that you might be able to get money into a Roth. So the first way is just Roth contributions. That's the first one. That's the primary one. So you contribute money every year to your Roth account. Now, this is where we have to be aware of there are income limits. So if you make above a certain amount, then you may be ineligible or may have to only be able to make a reduced contribution. But for 2025, I'll give you some of these numbers. So for 2025, the maximum contribution is $7,000 if you're under age 50 per individual, and you have an $1,000 catch up if you're over age 50. So it'd be up to $8,000 if you're over age 50. Now, again, to make contributions, you have to have earned income.
Okay.
So you have to get a W-2, you have to get a 1099, you have to have earned income. Yeah, whether it's being employed, self-employed, whatever the case might be. Now, you also have to have enough earned income to equal or surpass the amount of your contribution. So for example, let's say you're just doing some part-time work and you only make $5,000.
Right.
You can only make a $5,000 Roth contribution. You can make 100% contribution of that amount, but you can't make more than you actually earned.
Okay.
Right. Now, we had talked about income limits. You also have income limits. If you make above a certain amount, and for 2025, for single filers, if you make less than $150,000, you can make a full contribution. No worries at all. If you make more than $165,000, you cannot make any contribution.
Okay.
If you make in between there, you can make a prorated amount based on where you fall in that bracket between $150,000 and $165,000. So that's your single filers. For married filers, that same range is $236,000 to $246,000. So joint filers, you make less than $236,000, you can both make contributions. Make more than $246,000, you can't make any. Between $236,000 and $246,000, you make a prorated amount based on where you fall within that range.
Okay.
Got all that?
Well, I was thinking, and I don't want to make it all about me like you accuse me of, but say that my husband and I together, we make $200,000, okay? So he can put in $7,000 and I can put in $7,000, but what if he's the only one that's making money?
Doesn't matter. I'm glad you asked that. So there's something called a spousal contribution. So as long as together you make at least, and I'm going to let you stick with 7,000 and I won't throw the age thing in there just so we just don't get confused.
It's okay.
So technically you could both make $8,000 contributions, as I talked about earlier with the age 50 catch up. Am I not getting in trouble, right?
No, it's not. It's fine. It's fine.
So if you had no earned income, but he made at least $16,000, you can both make a contribution.
Got it. Okay.
Right?
Good to know.
So perfect. Yeah, that's a great, because that's one of the things actually we find, especially with our audience and our client base, where maybe they didn't work, or one retires at a different time, but the other still has earned income. If you're eligible to make a Roth contribution, we always want to look at doing so. And as long as one spouse is earning at least $16,000, you can both make full contributions in that year.
Okay, perfect.
All right, next we get to Roth conversions. And this is very simply, think about it this way, where we're taking money out of your pre-tax account, your pre-tax IRA, converting it to your Roth IRA, taking it from your pre-tax bucket, dropping it into your tax-free bucket. Now, there's some key implications here. Number one, there is no income restrictions and income limits. That has nothing to do with income. That was actually changed several years ago, where there were actually income limits to do conversions. That's gone away. So the biggest consideration is, well, what tax bracket am I going to pay tax on these dollars? So if I convert $10,000 from my IRA to my Roth account, what tax bracket am I in? Well, how much am I going to pay in taxes on that $10,000 or $20,000 or whatever it is? And that's, again, back to that concept of filling the brackets. Usually that's what we're looking at, is saying, okay, if I'm in a lower tax bracket this year than I think I'm going to be 3 years from now or 5 years from now, I want to pay as much tax at that lower rate as I can. So if let's say I have got $30,000 in taxable income, a single individual, $30,000 in taxable income, the top of the single tax bracket, the 12% is about 40, we'll call it 40,000 to make my math easier. I could convert about $10,000 and stay in that 12% tax bracket.
Okay.
Versus saying, okay, down the road, maybe I took a year off, whatever the case might be. But next year I'm going to be at a higher tax. I'm going to go back to work. Now I'm going to be in the 22% tax bracket. I'd rather pay as much tax as I can at 12 this year versus paying it down more in the future.
Absolutely.
And that's really where Roth conversions come in. Again, use that concept of filling the brackets. Now, there are circumstances where, again, I'm going to go back to the episode we did on the widow's penalty, where in the year that the spouse passes, I still get to file married filing jointly. So there are circumstances where we might do an excessive or a higher level Roth conversion in that year to take advantage of the joint rates versus, again, being in a single rate the following year. So there are circumstances where you might go above, where filling the brackets isn't the objective. It's, okay, I'm going to pay a lower tax rate this year than I might have to pay for the next 10 years or 20 years or 30 years, depending on the circumstances.
Yep.
So again, it's really about individualized planning and looking at your situation and determining what makes sense. Why would I want to do a Roth conversion this year or next year or whenever? The idea typically being, if I'm in a lower rate this year than I'm going to be in the future, then it typically makes sense.
Okay.
To at least explore it, right?
Yeah, absolutely.
All right. So next, number 3 is rollovers. So when you contribute, if you contribute to a Roth 401k at work, and then you retire or you change jobs, whatever the case is, you could think about making a rollover from your Roth 401k into your Roth IRA.
Okay.
And there's some reasons why you might think about this. Now, some of the rules have changed. So again, there's no longer required distributions from Roth 401k. So that's no longer an advantage of the IRA. But where the advantage typically comes in is through what we would call pro rata distribution rules. So as an example, when you take money out of a 401k, you don't get to pick and choose which fund I take the money from. So if you've got 5 different mutual funds inside of your 401k that you've been investing in, it prorates the amount that comes out of each. You get money comes out of all 5 of those. Versus in an IRA, I can say, well, the market's down about 25%. I probably don't want to take money out of my stock fund. I probably want to take the money out of my bond fund or my cash fund or whatever the case might be. So that is still the advantage of a Roth IRA versus a Roth 401k, is the flexibility of distribution and how I handle that.
That makes sense. I was wondering, I'm like, what is the difference? It doesn't sound any different at all.
From a tax perspective now, and again, no required distribution, there's a lot of advantages to both, but that's where it's more the income planning aspect that becomes the advantage over just the tax benefit or any of the required distributions, things like that.
Okay.
Okay, last one. And again, this one probably deserves its whole own episode. So I'm not going to spend a whole lot of time, but I think it's worth knowing that it's out there. And that is something called a backdoor Roth.
What?
Sounds fun, right? So these are tricky, but it's, again, worth knowing these are out there. I would always encourage you to talk to your financial advisor, talk to your tax advisor before even considering these. So back when we talked about the Roth contributions, we talked about the income limits, right? So if you're above a certain income amount, you are ineligible to make a Roth contribution. So the basics of a backdoor Roth are saying, okay, well, if I make too much money to contribute to my Roth directly, what I can do is contribute to my traditional IRA. It's not typically because of my income level. I'm at a high income level. That means it's probably not deductible, which means I make an immediate contribution to my traditional IRA and then do an immediate conversion to my Roth.
Okay.
So that's the basics of it. Again, consult your tax advisor, consult your financial advisor, but that is a way that if you're at a higher income level, you still may be able to fund your Roth account, but it's done via a backdoor strategy. Traditional IRA contribution, non-deductible, immediately converted to your Roth account.
Okay.
Talk to your CPA.
Please, please don't ask me.
That's right. Okay, now now we got to also make sure we understand the distribution rules. So as we go through the distribution rules, the biggest thing to think about is what's called the 5-year clock.
All right.
And the basics of it is, let's start, we're going to use contributions to start with. So in order for your money to be tax-free, the money has to be in there for at least 5 years. Your Roth account has to be at least 5 years old.
Okay.
So when you think about typical scenarios, okay, I've started contributing to my Roth when I'm 50. I've got to leave it in there for at least 5 years to avoid the tax implications, but I also have to be 59 and a half. So if I'm 59 and a half, it's been in there 5 years, everything I take out is tax-free. So that's, again, just being aware that the 5-year clock is there. Roth conversions have their own 5-year clock, and it's a little more detailed because it's based on each specific conversion. So you convert this year, and then you convert next year, you convert the year after. Each of those has their own 5-year clocks. Again, 5-year clock is the key. So the bottom line I would encourage everybody to do is start your clock as early as possible. Meaning, as soon as you can, put $50 into a Roth account, put $100, whatever it is. Start the clock today.
When's the best time to plant a tree, Eric?
20 years ago. 20 years ago.
The second best time is today.
Today. There you go.
Yes.
Got it. But yeah, so that is it. Start your clock as soon as possible. That way, once 5 years is over, you don't have to worry about, well, did I convert it? Did I contribute it? When did I convert it? When did I contribute? None of that matters. Start it today. Get your 5-year clock started. I'll put one other, I'll call it a trick. We have until, as far as contributions, I should have touched on this a little bit when we're doing the contributions. You always have until April 15th of the following year to contribute for the prior year. So for 2025, you can contribute for 2025 up until April 15th of 2026. Now, I call it a little bit of a trick as far as your 5-year clock goes, because even though I may make the contribution in April, my clock started the year prior. So even though you made the contribution a little bit late, it starts your clock basically the year for 2025. So I made the contribution April of 2026. It started my clock January 1 of 2025.
Oh, okay. So there's a little wiggle room there.
Yep.
A little bit.
Yes. And again, key age is 59 and a half. That's always going to be the fact to avoid any 10% penalties, anything like that. It's always got to be 59 and a half. And then we also touched on this as far as back on the episode we talked about with 7 ways to access retirement accounts without penalty. Hopefully, if you were tuning into that episode, if not, go back and check that out. But order of distribution becomes important with Roth accounts as well. So what order does money come out if you need access, whether it's an emergency or retirement? You want to look at the order of distribution as well. So you take money out of a Roth account, contributions always come out first.
Okay.
Right. So that's why in that episode, I was talking about if you had an unexpected emergency, I needed to take money out of my Roth account. As long as you had made contributions, those contributions come out first, which means there's no penalty, no taxes, regardless of age, regardless of circumstance.
I like
Then conversions. So
Mhm.
contributions first, conversions second, earnings are third. So the part that typically you have to worry about the taxes or the 10% early withdrawal penalties is usually the earnings. That comes out last. So again, gives you some flexibility if you are not yet 59 and a half as far as how the taxation of the penalties may work. So you want to be aware of those as well. So that's the order of distribution when you get ready to take money out.
All right.
All right. So we're ready to go through a kind of a wrap up. Anything other thoughts, clarifications, anything like that feel like we need to go back over?
No, I mean, I think I have a basic understanding of what you've talked about.
There you go. That's what we're shooting for, right? All right. So here's kind of our summary. So Roth IRA, think of it, it's not an investment. Think about it like an umbrella. The whole idea behind the umbrella is to protect your money from Uncle Sam. So Uncle Sam can't get to your money. It shields the investment from future taxes, ideally, again, as long as you meet some of these rules. Most people are going to fund their contributions through after-tax dollars, through typically after the money you've received from your paycheck. You take that money out of your bank account, you contribute it to your Roth account. We talked about also, again, the reason Congress has expanded a lot of these rules around Roth contributions and different types of Roth accounts, and some of the even required money that's going to be going into Roths is because they're looking for short-term revenue. But for us, that gives us long-term tax-free opportunities if we use it strategically. We talked about tax diversification being just as, if not more important than portfolio diversification. And Roth IRA dollars give us control over our tax brackets, over potentially higher Medicare premiums, over potential higher Social Security taxation. So that's really a key as to Roth IRAs playing that role of tax diversifier. We talked about the ways you can fund a Roth. So contributions, conversions, rollovers, and then potentially backdoor Roth IRA contributions. Work with your tax advisor. And then, of course, making sure we know the 5-year rule when it comes to Roths and order of distribution. What order does money come out of those accounts if and when you might need access to it?
Okay.
All right. So at the beginning of the episode, I talked about the free Roth IRA toolkit that I'm going to make available again at the simplyretirementpodcast.com. The really cool thing about all these are basically just think of them as like flow charts that are going to walk you through, okay, if I take money out of my Roth, have I met all the requirements for it to be tax free? Have I met the 5-year clock? Have I met all these different rules? So each of these tools is going to address, can I contribute? What happens if I take money out? Should I think about a Roth conversion? Should I do a backdoor Roth contribution? So all these different things are going to be incorporated in this toolkit. So again, go to the simplyretirementpodcast.com. It's going to be in the summary of this episode as well, so that you can have access to that. It's going to be a free download. You just pull it up and it'll walk you through each of those different circumstances that we've covered on the episode today.
All right.
All right. Well, as always, thank you so much for tuning in. As always, big thanks to Wendy. I'm glad we finally got to do your episode here.
Hey, thank you.
Well, that is it for today's episode. As a reminder, again, for all the links and resources that we mentioned, including that Roth IRA toolkit, visit the simplyretirementpodcast.com. Please don't forget to like, follow, and share the show. Until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
That's it for today's episode of the Simply Retirement Podcast. We hope you found our insights and advice helpful in planning for a fulfilling retirement. Don't forget to take action on what you've learned today. Visit our website at blakewealthmanagement.com to learn more about our firm and review our Simply Retirement Roadmap process to get you on the right path to the retirement you deserve. And don't forget to click the follow button to be notified when new episodes become available. Thank you for joining us on this journey, and we look forward to helping you achieve your retirement goals. Remember, retirement is not the end of the road. It is the start of a new journey. So embrace it and make the most of it. Until next time, take care. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor, Blake Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.